Picture this. You wake up on a Tuesday morning, and you remember your car insurance payment is due today. Your stomach doesn't drop. Your heart doesn't start racing. You don't open your banking app like you're defusing a bomb, holding your breath, hoping the numbers on the screen don't explode in your face. You just pay it, and then you move on with your day. The payment is just a task you completed, an item checked off a list. If that little scenario feels completely unrealistic, like a scene from a fantasy movie, you are not alone. Most of us have been taught to believe that a low-grade hum of financial anxiety is just a normal part of being an adult. It's a package deal, right? But here is the uncomfortable truth, the thing that most of us don't want to confront. That constant nagging money stress isn't just stressful. It's not just an emotional burden. It's making you dumber. I'm serious. Researchers from Princeton University did a study on this. They found that when people are under significant financial pressure, what psychologists call living in scarcity mode, their effective IQ drops, and not by a little. It drops by an average of 13 points. 13! Let that sink in for a second. It's the equivalent of losing an entire night of sleep. Except this time, you don't get to sleep it off on Saturday. This sleeplessness, this mental fog, can last for months or years. And this is why so many smart, capable people make terrible financial decisions. It isn't because they're bad with money. It isn't because they're irresponsible or lazy or don't understand compound interest. It's because their brain is overloaded. Their cognitive bandwidth is completely consumed by the immediate, pressing problem of survival. There's simply no processing power left for long-term planning, for weighing complex options, for creative problem solving. You can't think about the chessboard when you're just trying to keep from getting knocked off the board entirely. If that feeling sounds familiar, you're not broken, you're just overloaded. Financial stress is not about income. It's not about how much you make. It's about the buffer. The buffer, the gap, the little bit of space between what you have and what you absolutely need to survive. Think about it. Two people can earn the exact same salary and live in completely different mental worlds. Someone making $45,000 a year but with really low expenses and a small cushion of savings in the bank can sleep peacefully at night. Their world feels stable. Now take someone else, someone making $85,000 a year, but they have high fixed costs, a big mortgage, a car payment, student loans, and absolutely no savings, zero. That person is living one bad day, one unexpected emergency away from total panic. Their world is a tightrope. Because financial stress isn't about wealth, it's about volatility, it's about predictability. And yet, most of the advice we hear is about earning more, investing early, thinking about your 401k, planning for the long term. And look, that's good advice. It's solid advice, just not for someone whose brain is stuck in survival mode. Telling someone who's drowning to think about their retirement portfolio is, well, it's optimistic to say the least. The priorities are just not aligned. The first step isn't wealth. It's not about getting rich. It's about building a floor beneath your feet so you can finally stop looking down. So why does that first step, just saving a little bit, feel so completely impossible for so many people? Because you're paying something we can call the poverty tax. It's the 1,000 tiny cuts that bleed you dry. You buy the single item instead of the cost-effective bulk pack because you only have $5 in your wallet today. You pay the $35 overdraft fee because a bill came out 2 days earlier than you expected. You get hit with higher prices, higher interest rates, higher insurance premiums, all because you can't afford the upfront savings that come with having capital. It is expensive to be broke. Let's do the math. If you manage to save $50 a week, which, let's be honest, is genuinely hard for a lot of people, it takes you 20 weeks to reach $1,000. 20 weeks, that's 5 months. And that's assuming absolutely nothing goes wrong in those 5 months. But something always goes wrong, always. A weird noise in your car turns into a $700 repair. A toothache becomes an emergency root canal. A surprise medical bill arrives in the mail, and in a matter of minutes, weeks and weeks of hard-fought progress are just gone, wiped out. reset to zero. This is the cycle. This is why most people don't fail at saving. They quit. They quit not because they don't understand its importance. They quit because repeated resets, that feeling of climbing a hill only to be kicked back to the bottom again and again, it just destroys hope. And when you lose hope, you lose the will to even try. And this is the genius of the system that profits from it. Overdraft fees, payday loans, credit card interest, these aren't accidents in the system. They are features. They are designed to capitalize on that exact moment of desperation. So if you've ever felt like saving is pointless, like you're just spinning your wheels, you're not wrong. You're just early in the process. So how do people actually escape? How do they break that cycle? They don't escape by being perfect. They escape by being persistent. Step one is simple, but it's the hardest. You have to give yourself permission to be bad at this. Forgive yourself. Most people fail at saving multiple times, dozens of times, before anything finally sticks. But those aren't failures, they are data points. Each failed attempt reveals something important. It exposes a hidden fee you didn't notice. It exposes a system that is actively working against you. You cannot fix patterns that you cannot see. Step two is to get temporarily aggressive. Not forever, just long enough to build some momentum. This is where you channel that frustration, that anger at the unfairness of it all, because anger works when motivation doesn't. You start to hunt down the poverty tax. You avoid fees like the plague. You switch to a bank that doesn't have them. You question every single convenience charge. Why am I paying $3 to get my own money from this ATM? Why does this ticket app add a $5 fee at the very end? It might feel petty, you might feel like you're being cheap, but it is incredibly effective. Step three is understanding the critical difference between being cheap and being frugal. Cheap saves you money right now, but it costs you money later. Buying the $20 pair of boots that falls apart in 3 months, forcing you to buy another pair. Frugal often costs more now, but it saves you much more money later. Buying the $100 pair of boots that lasts for 5 years. But being frugal requires capital. You need that $100 to begin with. So you don't try to do it all at once. You focus on eliminating one poverty tax at a time, just one. You save up to buy the bulk pack of toilet paper, freeing up a few dollars next month. You use that to build towards the next thing. You make a series of short-term discomforts replace long-term damage. This isn't glamorous, there's no get-rich-quick secret here, but it works. And then, one day, it happens. You hit that first milestone. Let's say it's $1,000. And here's what happens when you finally have $1,000 saved. At first, nothing. The world doesn't change. The sun rises, the coffee tastes the same. It just sits there in your account. It almost feels anticlimactic until something breaks. Your phone screen shatters, your laptop dies, the transmission in your car starts to slip, and instead of that cold, familiar wave of panic, you just handle it. There's no debt spiral, there are no skipped bills, there's no mental freefall into despair, trying to figure out which part of your life you have to sacrifice. And that's when you realize what you actually bought with all that persistence. You didn't buy stuff. You didn't even really buy $1,000. You bought the absence of panic. You bought the ability for a bad day to just be a bad day instead of turning into a bad month or bad year. For the very first time, money is doing what it's supposed to do. It's solving a problem without creating 3 new ones in its place. And that changes everything. Because the most expensive part of being broke isn't the fees or the interest rates. It's the decisions you're forced to make when you feel like you have no other options. The buffer gives you agency. It gives you the power of choice, the ability to say no to a terrible job because you can afford to look for another week, to say no to a predatory loan because you don't need it, to say no to the desperate choice you would have made 6 months ago. Once the constant screaming alarm of panic finally quiets down in your head, clarity shows up. You can see the next step. And clarity compounds just like interest. You can think clearly for the first time in a long time.